When you cook, your required ingredients are determined at the very onset by the end product, that is, your dish. If you start preparing Rajma Chawal, you need to have the exact ingredients ready with you even before you start, right? The same concept applies to preparing a process note or sanction note of a loan. To make the process of sanctioning a loan smooth, correct, and complete in a time-bound manner, you need to learn to gather all the documents and information beforehand so that the process note is prepared correctly at the first attempt itself. But in reality, what do we do at our branches? We follow the checklist of documents provided by the bank. But the checklist is usually a one-size-fits-all type. It is meant for giving general guidance only. To prepare the process note of a particular loan, you need to have a mental vision of how the end product or the sanction letter will look like, just like your Rajma Chawal, so that you can backtrack the supporting documents and information required for it. Then only you will not stumble after preparing 70% of the process note just to find out that one vital document is not submitted by the customer at all. This way of mentally tracking back the required documents for a sanction loan and asking the right questions to the customer comes with practice, and the motive of this tutorial is to show you the way. So please stay with me till the end. Any sanction letter contains the following information. What is the purpose of the loan? Who are the promoters? What is the loan amount? And what are the securities? Your process note also talks about these elements and finally concludes with a recommendation. So let us cover all these four aspects and learn what supporting documents and probable questions or information are to be sought from the customer before you jumpstart preparing the process note. Purpose of the loan. If the loan is for purchase of machineries, the first document that should come to your mind is the quotation. Nowadays, we prefer quotations with GST number because it's easy to verify the genuineness of the supplier or vendor. If it is for constructing a factory shed and building, you should think for asking of plans, approval, and a land conversion certificate. Suppose you find out from the document that it is a leased land or a rented facility, then invariably you should check the terms and conditions of the lease. Just few days back, I came across a lease agreement where I observed the lessor has actually leased out his apartment for residential purpose and the lessee plans to set up a commercial shop over there. The lease rentals were not getting reflected in the projected profit and loss statement, which was wrongly increasing the profit value. The lease period is of 1 year and the proposed facility is a term loan of 7 years. So always cross-check and obtain clarifications from the customer before you proceed further. Background of the promoters. The promoters, partners, directors of a business are generally taken as guarantors. If you find that the business owner is an experienced one, then you should ask for supporting documents, for example, orders in hand, work execution certificate, past financials, income tax returns for last 3 years, etc. Just imagine a situation when you are writing promoters are vastly experienced in this field with a proven track record, and on the other hand, you observe from their income tax return that their gross annual income is carefully adjusted so that they have to pay income tax of rupees 2,000 or maybe 3,000 per year. Will it be appropriate to use those adjectives like vastly experienced and proven track record? Instead, you can give a clear picture that the company is a startup with promoters having little experience in the field. However, they are academically qualified and have good support from the network of their family business. Don't forget to take the relevant documents to establish your point. Loan amount. If it is a working capital loan, then by looking at the projected gross sales, you can quickly decide if the limit you are planning to sanction can be accommodated in a turnover method or MPBF will be required. Based on that, you need to frame your questions for the customer. Let's say your working capital request is for 25 lakhs and the projected gross sales is around 80 lakhs. Roughly 25% of 80 lakhs comes around 20 lakhs. On this, again you have to deduct margin. So one thing is pretty sure, this cannot be done in turnover method. Naturally, you have to switch your gears and shift to MPBF. Remember, MSMEs are eligible to get the maximum amount in either of the two, right? If that is the case, it's time to take a look at the holding levels in the CMA. If figures are unreasonably high, it's time to ask a question and get clarification. Similarly, if the projected sales figure are higher and beyond your level of comfort, it's time to revise the projection. Don't fall in a trap when someone says you revise this at the time of assessment. I tell you why. When you scale down the sales, naturally the current asset and current liability figures should also get changed. The profitability is going to change as well. Now if you have committed, ठीक है हम बाद में देख लेंगे, at the time of assessment you may land up in a mess. If on the other hand you realize that the assessment can be done by turnover method, then you can remove your focus for the time being from holding level and realization period. For complete details of turnover method, you can refer to our previous videos. They are available both in English and Hindi. Also, before sanctioning a working capital facility, you must check the capacity of the plant and machinery and also the storage capacity of raw materials and finished goods. Quite often, I come across a situation when the firm has requested for a working capital to procure cloths of 30 lakhs, but his shop doesn't have the space to keep it. So you need to be careful in all such cases. Don't forget to mention this in your unit inspection report. Perhaps that's the only tool available to create evidence for a later date. Securities. At the time of collecting the requirements itself, you have a fair idea of the loan securities that are being offered. Securities in the form of land and building are associated with valuation report and legal reports. It's not that you have to only obtain and keep them. You have to read them and understand the meaning, then ask the right questions. Many a times I find differences in extent of land mentioned in the valuation report and the legal report. That might be due to the fact that the legal report is based on the sales deed or gift deed which was prepared say around 20 years back, and a valuation is prepared on the basis of the present situation. Especially in urban and metro areas, many times due to road winding activities or other developmental reason, some portion of the land may get sacrificed to the government. This might lead to minor differences. It's always a good practice to keep things in black and white and ask for the reason. Because you never know that the difference might be due to litigation or some other reason which can make the security unacceptable. The customer will always try to convince you that although the extent of land shown in valuation report is less than what is mentioned in the legal report, since the valuer has given valuation for the lesser land area, there is apparently no issue in accepting the same. However, there is a catch. What if the sacrificed land was the entry point to the plot, now leaving it landlocked? Consider one more situation where your panel advocate mentions the flow of title and it goes like this. Mr. A sold the property to Mr. B in 1992, then Mr. B sold the property to Mr. C in 2001, and Mr. X sold the property to Mr. Y in 2005. Mr. Y is having a clear title to create a mortgage in bank's favor. Is this acceptable? Is there anything wrong about this? When Mr. C was the last known owner in 2001, how come Mr. X sold the property to Mr. Y in 2005? Bankers are not legal or valuation expert. But if we spare some time to ensure that these reports are prepared in bank-specific format, whether any important field has been deliberately omitted or not, and at least try to read and understand the entire report, then it can be good enough to save our skin.